Hello and welcome. My name is Kate Marand. I'm a program manager at the Department of Small and Local Business Development here in Washington, D.C. for our Innovation and Equitable Development Division. We've been hosting a spring webinar series for our small businesses and entrepreneurs here in the district this May 2024, and we are incredibly excited today to have our partners in government at the Department of Insurance, Securities, and Banking, as well as partners from the federal government with the U.S. Securities and Exchange Commission to talk to DC entrepreneurs and small businesses about Investing 101. I'd like to turn things over to Dolly Turner, who is the Chief of Staff at the Department of Insurance, Securities, and Banking. Thanks so much. Thanks for being here.
Thank you. Well, we're excited to be here. Thank you, Kate. In case you all didn't know, for our small business participants, the Department of Insurance, Securities, and Banking and the Department of Small and Local Business are great collaborators throughout the year, and they're actually one of our favorite government partners. We're really excited today to share the Investing 101 workshop with our esteemed co-sponsors, the U.S. Securities and Exchange Commission. We believe that today's workshop will really be of great value to you as business owners and personally by supporting your financial health and wellness and providing you with resources and information. We empower you to make good decisions that are fundamental to your success, profitability, growth opportunities, and most importantly, creating wealth. So I'd like to introduce our speakers today. First, we have Stacey Bowers, who's Director of the Securities and Exchange Commission's Office for the Advocate for Small Business Capital Formation. We also have Tom Manganello, who's Senior Counsel of the SEC, Securities and Exchange Commission, Office of Investor Education and Advocacy. Also joined here today is Jane Brady from the Office of Advocate for Small Business Capital. A little bit about Stacey. She joined the office in January and brings a broad range of experience to the role. She was most recently a professor of the practice and director of the corporate and commercial law program at University of Denver Strum College of Law, where she taught courses in corporate law, including capital raising and accounting for lawyers. Wow. She also served as of counsel at Three Pillars Law PLLC, where she represented small business owners and entrepreneurs seeking to raise capital. Prior to joining Sturm College of Law, she worked in private practice as an in-house securities counsel for 2 public companies. She began her legal career as a staff attorney at the SEC's Division of Corporate Finance. Thank you, Stacey. Tom Manganello. I'm so sorry, Tom. Tom Manganello. I have the hyphens and everything on my page. Is Senior Counsel of U.S. Securities and Exchange Commission, Office of Investor Education and Advocacy. He has more than 2 decades of distinguished service as a private sector and government attorney, financial literacy educator and communicator, and fraud investigator. He regularly guest lectures on building wealth over time through saving and investing at universities, military installations, and government agencies, libraries, high schools, nonprofits, and conferences. And his decade of SEC Enforcement Division experience investigating violations of the federal securities laws provides very timely and actionable education on building wealth while avoiding scams. He also writes for the SEC's award-winning website for retail investors, investor.gov, and the SEC social media channels. Thank you both for your time today. I'll tell you a little bit about the Department of Insurance, Securities, and Banking, and we can move to the next slide. DISB, as we're known, is the regulatory information for insurance, securities, and we'll go one more slide, and banking. What we help to do is, and you can click twice, we ensure that there are highly qualified financial services available to business owners and residents. Our role is to protect business owners and residents from bad actors and ensure policies are in the best interest of our residents. We license all of the financial services companies doing business in the district, and we examine them regularly to make sure they're in compliance with the requirements and that they remain solvent, meaning when you go to the bank to withdraw money, when you file your insurance claim, they are able to pay out on those. Lastly, we provide financial education and empowerment with workshops like these that will enrich our small business community. Lastly, you may have heard about our small business access to capital program called DC BizCap that really helps to increase capital, and we can share more about that a little later on. So lastly, two things I'd like to share is just some of the next slide, resources and services that we provide. Foreclosure prevention and mediation. The mayor has a fund set up to assist with residents who have challenges with their mortgage, reverse mortgage education, estate planning, flood insurance information for residents and small businesses, mental health parity and substance abuse insurance awareness so that you know your rights and have access to mental health insurance. Our student loan ombudsman, yes, we're the people who help with student loan forgiveness or help you work out payment plans with your student loan funders, business insurance, and financial empowerment resources. And then lastly, on our next slide is if you have any sort of issue with your insurance company, bank, or securities firm, agent, broker, representative, we're the agency that can help you. If it's a complaint or a concern, here's our contact information. We help you to understand your rights, and we serve as your advocate. We help to ensure that the rules and regulations are enforced and that are followed. We will investigate these complaints and resolve any issues that arise within 45 days or refer it to the appropriate regulator. And with that, I will turn it over to Stacy.
Great. Thanks, Dolly. Thanks for, I just learned a lot, that's for sure. All right, so before I get started today, I'm going to give our standard disclaimer. So while Tom is here in his official capacity as Senior Counsel with the Office of Investor Education and Advocacy, and I'm here in my capacity as the Director of the Office of the Advocate for Small Business Capital Formation, the views we each express today are our own and do not necessarily reflect the views of the Commission, the Commissioners, or Commission staff. I also want to add, during the presentation, one of our colleagues, Jen, who you met a little while ago, she'll be dropping some links in the chat to various resources, reports, and websites that Tom and I might mention. So with that, and I'll go to the next slide, I'm going to touch very briefly and at a high level. I'm going to tell you a little bit about the SEC and its mission. I'm going to talk a little bit about our office, what we do. Then I'm going to shift gears and do a little bit of a discussion about capital raising. And I'm going to highlight some of the educational tools and resources that our office has put together for founders and investors. I'm only going to be on the stage. I'm going to try and be here just a short time today, probably about 10 minutes or so. And then I'm going to turn it over to Tom, and he's going to provide a lot of wonderful information related to investing. All right, so with that, I'm going to go one more slide ahead. So as I mentioned, or as Dolly mentioned, we are the Small Business Advocacy Office here at the SEC. So you might wonder, well, where do we fit in? So the SEC has a three-part mission, and that includes protecting investors. And you're going to get a chance to hear Tom speak about that part of the SEC's mission. The second part is to maintain fair, orderly, and efficient markets. And then the third part is to facilitate capital formation. And that's really where the Small Business Advocacy Office comes in, that facilitating capital formation, and in particular, as it pertains to small businesses and their investors. So next slide. So I'm lucky enough to serve as the director of the Small Business Advocacy Office. And as Dolly mentioned, I just started in January, so I've only been in this role for about 4 months. And our office actually has a legislative mandate. And our mandate is to advance the interests of small businesses and their investors at the SEC and in the capital markets. So in conjunction with that mission, we work to identify and address the unique challenges that underrepresented small businesses and their investors face. And we do that by focusing on issues that pertain to minority-owned, women-owned, rural, and natural disaster impacted businesses, as well as their investors. So we deal, and I also want to say we run the gamut. For us, a small business is a startup business, a business that's just getting started, up to and including a small company that is a publicly reporting company. So how do we approach or accomplish our mission? So one of the main things we do are events like this. We love to do outreach. We like to talk to small businesses. We like to talk to investors. And we try and talk across those, unique areas that I identified above. In connection with our outreach, we want to listen and learn. And that's what helps us really gather information and knowledge. And we take that back into our team and we build educational tools and resources based on what we've learned in hopes of helping small businesses and investors in their capital raising journey. We don't think our tools and resources are just for those groups, though. We also think they're for other parties working with those groups. So maybe lawyers, accountants, accelerators, organizations like are on this webinar today. And so we really try and design very user-friendly resources to run the gamut. The second thing that our office does is we review rules and regulations that the SEC proposes because we're looking to see if there's going to be a disproportionate impact to small businesses and investors. And then we'll create educational videos to help our stakeholders when new rules are finalized. So they have some information about how best to implement those rules and make sure they're complying with them. And then finally, our office makes recommendations to Congress and the Commission based on information we learn from our stakeholders through venues. And that's all of our outreach venue events that we have over the years. So that's kind of the advocacy piece for us. All right, so what does it mean to raise capital? So one thing, and I'm going to go to the next slide, Tom, sorry. One thing that is important to understand, and this matters whether you're a small business owner raising capital or you're an investor who's looking to invest your personal funds, that when a company makes an offer to sell or sells a security, that security has to either be registered with the SEC, so you might hear the phrase initial public offering, or that security has to be sold under an exemption from the registration requirements. So you might be thinking, well, that's really great, but what the heck is a security? And how do I know if I'm even selling one and buying one? And those are great questions. So we'll go to the next slide. So while most people have a sense, they hear the term common stock or preferred stock, and they're like, oh yeah, that's a security. I know that. That's what trades, I follow NASDAQ or New York Stock Exchange, or I read about public companies. But there are a lot of other instruments that are also sold that fall into that category of security. So for instance, when a company sells an ownership interest, a limited liability company sells an ownership interest, that's generally a security. Not always, of course, not always. We're lawyers, there's nothing definitive, but that's generally a security. Selling a convertible instrument, so meaning an instrument that's going to convert into an ownership interest in a business in the future, that is generally also a security. So you might hear terms or run across terms, convertible promissory notes. You might hear the term SAFE, which is a simple agreement for future equity, or a KISS, which stands for Keep It Simple Security. Those are convertible instruments, and those are also securities. But then I want to touch on the opposite, that there are a lot of things that businesses do to raise capital to fund themselves and their growth that don't fall into that category of securities. So a bank loan, a federal grant, or a donation. Those are things that would not actually be securities and so would not be subject to the securities laws. So who are early stage investors? So you were actually on the right, yes. So when we're talking to founders and investors, and I'm going to give a little background before I talk about that, we talk to people who are often at the early stages of capital raising or capital investing. And so maybe the business has gotten a loan or a grant, and now it's looking to take that next step to expand. And so when that happens, these small companies, they often seek to get capital from their friends and family, maybe an angel investor, or if they're lucky, in very few cases, they might have a venture capital firm that wants to give them capital. So to answer a question that might be going through your mind, if I sell an ownership interest in my business to my friends and family, did I really sell a security? They're my friends and family. And if I invest in a friends and family's business, for an ownership interest, did I get a security? And I'm going to say the answer to that is yes. So it's something to keep in mind. I also want to share companies that are raising capital externally. So they're not using their personal funds or their cash reserves. 42% of companies raise capital in that manner. But to give some perspective, of those external financings, only 8% come in the form of equity investment or this investment capital that I've been talking about. So next slide. So one of the themes that we also hear across the board from early founders, they all are facing financial challenges. It's hard to start a new business and get it off the ground. 78% are concerned about whether or not they can raise capital. And we also know from our research and a report that we put together annually that the starting line for founders, it's not the same. Diverse founders start at a disadvantage, and part of that is a result of the wealth gap that exists in our country. And you can see from this slide that in 2022, diverse teams raised 33% less capital than all white teams of founders. That's a really significant disadvantage to face and tackle when it's already so difficult to start a new business and get it off the ground. I also want to just share a little bit that women founders often face a lot of the same obstacles, and all women teams receive less amounts of funding than mixed gender or all male teams. And I will also say that 70% of women founders think that their gender is holding them back. We put together, I'm going to brag about the office, and I get to do that because I'm still so new. So this is work that happened before I came on board. Our office puts together an annual report. The 2023 annual report is amazing. And we like to say it's not your typical government document. You're not going to get in there and see 100 pages of dense information. We use a lot of graphics and charts and data, and we break it down in a lot of different ways. So if you're interested in digging in and knowing a little bit more about the state of small business capital formation, that's a great place to go. All right, so now I'm going to do my first switching gears, and I'm going to talk a little bit about capital raising and try and do that without overloading our brains. So the next two slides, they really talk about the different ways that businesses raise investment capital. So I'm not going to go into this in depth, but I do want to say that most businesses rely on Regulation D. So you can see here the 506B and the 506C exemptions from registration. So a lot of capital is raised that way. The other way that businesses raise capital is through crowdfunding. So one of the things that's important to know, and this matters whether you're raising the capital or you happen to be investing and you're buying into one of these offerings, is that every exempt offering has its own requirements. And it's really critical for founders to understand those requirements because they want to make sure they're complying with the securities laws. One of the best ways to do that is for them to work with an attorney. But with all of that said, I want to touch just in a bit more detail on regulation crowdfunding, because this is an exemption that's used by quite a number of small businesses, and in particular, businesses founded by diverse teams and women-owned teams. They tend to use crowdfunding quite a bit. And the other reason it matters is that anyone can invest in a crowd fund. So for all of you who are here thinking about, I have some personal funds, where might I be able to invest them? One of those paths is through crowdfunding. So if we go to the next slide, it's going to lay out just in general how companies are raising capital. But if you take a look, 352 million was raised through crowdfund offerings. And to give some perspective, when a company does a crowdfund, they can raise up to $5 million in a 12-month period. They don't have to do it all at once, but they're limited to 5 million over the course of 12 months. And as I mentioned, anyone can invest at a crowdfund. And the nice thing about crowdfunding is often those companies, the amount that you have to invest to participate can be relatively low. So as an investor, you might be asked to only write a check for $100, $250, $500. So it's an avenue for people as they're starting to think about investing. It's one of those avenues that's open to a lot of investors. But I also want to point out that as a potential investor, you might face some limitations about how much you can invest into crowd funds over a 12-month period as well. And that's going to come about through a calculation based on your salary and your net worth. But I do want to share, because we're in the DMV area, so I want to say in 2023, there were 6 crowdfund offerings in Virginia, 10 in Maryland, and 7 in the District of Columbia. That's not a huge amount of crowdfund offerings going on in this general area, and hopefully we'll see those numbers start to grow. To give the other perspective, in 2023, there were 162 crowd funds in California. And then it drops off significantly, but the states after that were New York, Florida, and Pennsylvania doing the most crowd fund offerings. So Pennsylvania, my home state where I grew up, not far away. All right, so now I'm going to do my last switching gears, and I'm going to highlight just some of the educational resources that our office provides. I've got a number of slides in here. I'm not going to go into them all in detail, but I do want to highlight just a few before I turn it over to Tom. But you'll find within our slides, we also have embedded links. And this is where I'm going to ask a favor, Tom. Can you click on that funding roadmap icon for me? Hopefully it will open up. So this is the only resource, and if it doesn't, that's okay. So we have a funding roadmap, and this is a really good place if you're a small business and a founder to start when you're thinking about raising capital. Because our roadmap is going to start even really before our office comes into the mix. It's going to talk about maybe you want to raise capital through a grant or a federal program that the SBA supports or an SBDC supports. So it's going to walk through that and kind of take you through the process from starting there as you move through and get to the point where you might be thinking about raising investment capital.
Are you seeing it, Stacy?
No, it did not pop up, but that's okay.
Okay, I apologize. Yeah.
No, not a problem at all. Thanks for trying. So the next slide talks about our building block, and it goes back to something I was mentioning before. You might get money from your friends and family. You might get from an angel investor. You might get from a VC. The nice thing about this building block, and that's kind of when you have a chance to look at them, there's sort of a single page. It's going to give you some insight when those investors might come into the mix and what their expectations might be of you. Or on the flip side, maybe you want to be one of those friends and family investors. So it's going to give you a sense of when you might come into the mix as investor and what your expectations might be. The next slide and our next resource is just pathways about capital raising. We already talked a little bit about that. The one thing I want to mention with our resources, when you get into them, there'll be a lot of links. So you'll see links that'll take you to a cutting through the legal jargon glossary that we've developed. So if you want to know what the heck does this term mean, you can click on that link and it's going to take you to a glossary that combines our terminology as well as I think investor education's terminology about what do these terms mean in more everyday language. And then also there'll be links to other resources that are out there on the SEC's website. Lastly, I like to brag about our stuff. So here's the link to our capital raising hub. Please spread the word. There's no greater compliment to us than somebody shares about that. And then finally, my last slide is just to let you know about how to reach us. So remember, we are an advocacy office for small businesses and their investors. In order to advocate, we want to hear your voices. So reach out to us, share your experiences, ask us questions. If we can't answer them, we'll try and connect you to the right person at the SEC. And then again, lastly, use our resources, share them. I think you'll find them helpful. And with that, my time is up and I'm going to turn it over to Tom for the rest of the session. Thanks.
Stacy,
And
thank you.
Tom, I guess before you start, I thought I saw something in the chat. Can everyone see their slides? Okay, good.
Stacy, thank you so much. That was awesome. And Jen, great job providing those important links in the chat box as Stacy's presentation went along. Such important information that Stacy just went over on how some options that you may have to finance your business. I'm going to talk for a few minutes on the flip side of the coin and maybe your personal finances and your personal financial journey, which is also as important as how you'll be financing your business. And we have a relatively simple roadmap that has worked for so many folks on how to build wealth over time. Obviously, there's a number of ways that people do build wealth. Some of them do start successful businesses that become very profitable. Some people have extraordinary income through their jobs or through some other source, inheritance, lottery winnings. Some people may be lucky enough to have other sources of income that are just extraordinary. But for most of us, One of the two most important sources of building generational wealth will come from home ownership, or in your case, maybe your business ownership as well, the property that you hold your business in, and investing, saving some portion of what you earn over time. And we're going to talk about this as the basis, the roadmap for building wealth. Our website is investor.gov, the website that helps individual investors, retail investors, build wealth and spot and avoid scams. It is an intuitive and user-friendly website. This is our landing page. It has a number of useful tools, including the ability to quickly check out your investment professional. If you're going to use, for example, a broker or an investment advisor. Brokers will let you buy and sell securities. Investment advisors can provide investment advice. So critically important if you're going to employ an investment professional to make sure they're licensed and registered. In my 10 years in the enforcement division, so many of the cases I saw that targeted or exploited investors were initiated by unlicensed, unregistered investment professionals. So truly, if you can just take that one step, it can insulate you from some portion of the scam market. You can do that in about 2 minutes, about as much time as it takes you to do a Yelp review for the nearest restaurant. Lots of other good stuff on here. I'll let you look at investor.gov on your own time. The gray box on the bottom are investor alerts and bulletins that our team in OIEA regularly write. Bulletins tend to talk about investment products or trends. The alerts tend to focus on the scams or the fraudulent investments that our enforcement division is seeing. And then on the right under additional resources, you see that I've dropped the drop down menu comes down, and one of the options is entrepreneurs. That will take you directly to the office of the advocate for small business and some of those wonderful resources that Stacy just went through. Okay, including their landing page, which is also intuitive and also brings you to relevant resources that you may want to use. Before I talk about the 3-step roadmap that is relatively simple, I like to point out to folks who might be new to investing that there are certain mindsets that leave the ground fertile for building wealth. And one of those is just having the ability and the discipline to distinguish between what you need in life. We need oxygen, we need water, we need a couple meals a day, we need shelter, and the things that go beyond our basic needs and become either luxuries or wants or whatever you want to call them, but they end up requiring us to spend a lot of money on things we don't necessarily need. So like I give the example, I love a cup of coffee every morning. I tell people I need caffeine, but I definitely don't need an $8 venti pumpkin spice latte at Starbucks. Every once in a while I do it, but I don't do that on a regular basis just because I know it's expensive. My nephew loves Taco Bell. His meal is reasonable. It's $8. But what does he do 3 out of 4 times? He door dashes it straight to his house. And he turns that $8 meal into a $22 meal. That took the meal, and made it a luxury, right? The ability not to go to the store, not to prepare your own food, have fast food direct delivered by somebody else. We don't want to do this on a regular basis because it will start to dominate our conscious spending plan. Whatever that budget is, or conscious spending plan, I like as a better term, you want to make sure you carve out room for yourself, for your future self. You want to have some room to save and invest. If I'm talking to older people, that's a different number of expenses. If I'm talking to folks who are in their 20s or their 30s, oftentimes one of their largest expenses is a vehicle, their car. A lot of people who either go to school or start a business or have a tech degree or whatever it may be, want to have an outward demonstration of their success. And a car is sometimes the easiest way to tell your peers and your friends and your family, hey, I made it. I've worked hard. I have a $50,000 Tesla or a Charger or a Ford F-150. And it does look good, at least for a certain amount of time. And it does feel good and smell good to have that new car. But I do like to remind folks, oftentimes a $50,000 car comes with what is essentially $1,000 per month car payment. And some folks have those payments for 4 years, some for 5 years. I've even seen 6 and 7 year car payments of $1,000 a month. And what does that do? That squeezes out so many other important financial priorities. And so I challenge folks, what about a $25,000 car? It may not be as sexy, but it may bring your monthly car payment down below $400. And what does that do for you? What's in it for you? Well, what's in it for you is you may have extra money to put in the savings account in the bank. You'll have extra money to invest in whatever it is you want to invest in for the future. And you'll even have more spending money. And I also like to remind, especially younger people, that you're not always going to be talented and young and good looking. You may be good looking and talented, but just a few more years older someday. And just like Obi-Wan Kenobi here in this image, the goals that you have in the future for future you may be just as important as the goals that you have today. And so if that's good incentive to just set aside some portion of what you earn for future you, who's still important. You may not be able to visualize this person, but trust me, that person's going to have important goals, one of which may be, I don't want to work anymore at some point, and I want to have some amount of money, some nest egg accumulated that will allow me that luxury of having a comfortable retirement. And one more analogy here. You know, if you think of every stone in this graphic as 2-week period, of course you have the ability, if you choose, to spend every dollar you earn in the next 2 weeks on the person who's standing on that first stone. But the person that will shortchange isn't somebody else, it's you. It's the you who will step on the next stone, and the you who will be on 5 stones after that, 20 stones after that, etc. So we want to remember that person and keep your longevity in mind as you make financial decisions, because you're going to be here a good long time. If your parents are still around, if your grandparents lived a long time, you probably have great genetics. You're going to be here a long time, and you want to take care of that person who steps on those future stones. You know, the roadmap to building wealth isn't so complicated. It's 3 steps, and it starts with just being disciplined with how you approach high interest debt. I consider high interest debt things like credit cards, MasterCard, Visa, Discovery. You know, the average APR or interest rate on a credit card that you don't pay off the balance for at the end of the month right now is 20%. That's high. The average interest rate on a credit card issued by a retailer, whether that's Macy's, TJ Maxx, Abercrombie, A&E, can be 30%, 32%, even 36%. Really, really high interest rates. And that's why on this graphic, you see that the interest you pay out to the bank or to the credit card company is often much more than you could expect to receive in money invested in the bank or in some other investment product. So we want to be disciplined about paying down debt as a first order of business. Step 2 in the roadmap is to have an emergency fund. You know, studies have shown 40% of Americans would not be able to afford an unexpected expense of $400. And so for 4 out of 10 of us, if we dropped our phone and cracked our screen, we'd have to borrow money from a family member or put it on a credit card and pay it off over a long period of time. We don't want to do that. It's important to have a rainy day fund or some money set aside because some of your expenses no doubt will be anticipated, right? Your business expenses, your rents, your leases, your utilities, etc. But then life is going to throw us a curveball. We're going to have a car repair, a health crisis, something's going to come up. So you want to have a buffer that can protect you against that. Starting with a modest amount of money and building yourself up to the point where at some point you have a few months worth of expenses put aside for these types of unexpected expenses. And then that brings us to the most important step, which is you want to invest some portion of the money that you earn, and you want to start that at the beginning of your business journey, your work journey, your investing journey, and you want to keep doing this throughout your life because there is this proven and powerful formula. The regular investments that you make plus time, time is your superpower, equals wealth. Regular investments plus time equals wealth. You want to get this process rolling as soon as possible because it really is like a snowball. You pack a snowball tight, you put it on the ground, you start it through its first rotation, and a snowball is going to pick up some additional snow, especially where Stacy's from in Denver, where they really do still get snow. Doesn't seem to happen here in DC. But what does that do? That gives the snowball some additional snow, some additional surface area, so that by the time we're starting that second rotation, the snowball has the ability to pick up additional snow. That's how investments can work for you, especially when you're making regular contributions to an investment and you keep doing that over time. Now, just a 30-second review on some common investment products so that you can appreciate how that snowball rolls. Stocks are where you literally own a tiny percentage of a publicly traded company. You could own a tiny percentage of Home Depot. That company can then profit. The stock price may go up. If you bought low and sell high, you can make money that way. Some companies may even share their profits with stockholders. Those are called dividends, and that's another way your snowball can rotate and grow over time. Bonds are a little different. When we hold bonds, we don't actually own a percentage of the company or a percentage of the government. Instead, bonds are sort of like making a loan or an IOU. Maybe the District of Columbia government will issue bonds. What are they doing with your money while you buy these bonds? They're taking your money. They may build a bridge. They may improve a road. They may build a school. They'll hold on to your money for some time. While they have your money, they'll pay you interest. It's usually twice a year. And then at the end of the bond period, whether that's 5 years, 10 years, 15 years, they will return your principal, the money that you originally invested in your snowball rolls. Now, for a lot of us, the more common way that we will invest in our life is mutual funds or exchange traded funds, or perhaps we have a salaried job that has an added benefit of an employer provided workplace retirement plan. These are sometimes called 401ks. In those cases, we're buying shares of a fund that will in turn, an investment company that will in turn invest in other securities, whether it's dozens or hundreds of stocks or bonds or other types of securities. And your money can grow a couple different ways. One, if the share price of the funds increases because those underlying companies increase in value, or two, if those underlying companies are paying in their profits to the fund itself, you may grow and increase the number of shares you hold. All the while, your snowball rolls. Why do I mention funds? They're often the investment of choice in individual retirement accounts, in 401ks, and other types of investments. So it just becomes a more common way many of us invest. And then as an added bonus, we get diversification when we hold funds. In other words, we're not putting all of our eggs in one basket. When we hold shares of a fund, we're probably spreading our investing eggs among multiple baskets, multiple companies, multiple industry sectors, right? Multiple different investments, maybe even different assets. That was Investing 101. How might it look to you? Let's say you commit to start your business and you're going to put $100 a month into some investment or some bank. If you did $100 a month and you did it over an average career, we're just going to say for simplicity, you're going to work 4 decades, 40 years. The amount that you will have contributed is that orange line on the bottom, $48,000. That's $100 a month times 48 years. If you put that money in a bank, say a checking account, and even if it was a good checking account and you were getting about 1% interest over those 40 years, would your snowball grow? It does grow. It does roll. It does rotate. It expands, but not so much. A 1% return is only going to move your money up to about $58,000 over those 40 years. But if instead you would invest it, and if we assume that that investment would pay an average return of 7% over those 40 years, now you see your money would grow to almost $250,000, even though, again, you only contributed $48,000. The delta there is your snowball rolling, your money working for you. Not so much at first, as you can see here, but quite a bit as you move throughout your work life, your business life, your career. And this is just putting that powerful formula into practice. Regular investments plus time, the more time, the better, right? More rotations of that snowball equals wealth. Two things if you're new to stock investing. One is, and I use a graphic that shows how stocks have performed over the last 30 years. This is a Standard & Poor's 500, the biggest 500 publicly traded companies in the United States, how they've done over a 30-year period. And I hope when I ask folks what the first thing they notice here is, most people say, wow, volatility, ups and downs. It's all over the place. I was speaking to future doctors at Walter Reed Medical Center in Bethesda about a month ago, and they said this looks like a heart rate monitor. It kind of does. And so lesson one, if you're new to investing, is that stock investing does tend to have volatility. There will be good years, good months, bad months, good weeks, of course. But the second lesson, and so what's the point of that lesson? The point is, when you start stock investing on a regular basis, I want you to expect bad days and bad months, bad years. It's okay. You don't have to panic. You don't have to pull your money out. You don't have to stop your strategy of making regular contributions. Because what's the trend that you see here, despite the volatility? Yeah, I mean, you see that the trend is up. And it's not only up over the last 30-year period, it's up even if you go back to the stock market crash of 1929, which is hard to believe, is almost a century ago. Stocks have paid in that last 100 years between 7 and 10%. Two lessons here. You will see volatility, but historically, long-term investors, folks who do this for 10 years, 20 years, 30 years, 40 years, have done very well. And because this formula means the longer your snowball rotates, the better you do, right? Regular contributions plus time equals wealth. The earlier you start, the better off you are. If
Tom, I think you have a question in the chat.
Oh, I'd love to hear it.
The question from Ebony is, where should an older investor start, like a middle-aged investor?
Yeah. Well, Ebony, you've hit upon an important theme. The way you invest will be informed by your time horizon, or in other words, when are you going to need your money? Someone who's 18 years old, like in this graphic, probably won't need their invested money, especially if it's in a retirement account, like an individual retirement account, or an IRA, or maybe in a workplace retirement account. Probably not going to need that money for a long time, maybe decades. That person is probably going to be invested in stocks, because stocks have done very well over time. There is a lot of volatility, but they're willing to accept that volatility, because even if there's a market correction or a bear market, a bad market, a recession, they have a long time to recover from that, and they don't need their money soon. Someone who's in the middle of their career may want to be in a more conservative mix of investments. That may be more bonds and some more still stocks, but some additional bonds to balance out their portfolio. Or maybe they'll choose a fund that's called a target date fund, where you literally select a date at some point in the future when you think you'll need your money. Maybe I'm 45 years old. I'd love to retire by 65. I do a 20-year target date fund, or a 2044 target date fund. Had to do my math there. Why would I choose a target date fund? Because those make asset allocation decisions or investing strategy decisions for you. Someone who has 20 more years to invest will have a mix that is a little bit aggressive at the beginning of their 20-year period, and it will slowly but surely and automatically, this is kind of an autopilot thing, change the mix of investments to a more conservative mix as you approach retirement. And so those are just some thoughts for you. The older you are, the more conservative you might be. Target date funds take that into consideration. Why? Because they're going to gear your investment risk strategy to your target date. And so back to this slide, which kind of builds on what you just asked, Ebony. If you wanted to have $500,000 by the time you're 65, we can use the investor.gov compound interest calculator to see that the earlier we start, the better. Obviously, an 18-year-old who has so many rotations in their snowball doesn't have to put nearly as much into an investment as someone who's 45, who wants to hit that same number. Someone in 45 has to put almost $1,000 a month in. Someone who's my age has to put $3,000 a month in, right? That's exorbitant. And you might get discouraged by this slide. Some people do. They're like, oh, forget it. There's no hope for me. But indeed, there is hope, because it's always better to start that investment snowball rolling now than it is 5 years from now or 10 years from now. There's time to make up some time, some ground in your investing. Ancient proverb, right? What's the best time to plant a tree? This reminds me. Well, probably 20 years ago. Why? Because we would have shade now. We would have fruit. We'd have beautiful flowers in the spring. But the second best time is today. And so I think that fits with investing too. I always wish, believe me, and I'm guilty of this myself, my 20s were a wasteland of wealth building. I finished my 20s with negative net worth. I had more debt than I had assets. I had never earned more than $25,000 any year in my entire decade of my 20s, and I started behind the 8 ball. But it's no use being discouraged. You meet yourself where you are, you have some grace with yourself, and you begin this journey using this roadmap. Now, that was it. That was the whole roadmap. Pay down debt, have an emergency fund, start saving and investing some portion of what you earn. Now the question is, but what do I invest in? We're with the federal government. We don't make recommendations. Obviously, we can't give investment advice, choose a hot stock, choose a fund, that sort of thing. But there are some attributes that make certain investments better than others, or advantageous generally. One is if you get some sort of match. Another is if you lower the taxes you pay as a result of making that investment. That's really great. Very unique among very few investments. Bonus, if you diversify your portfolio and if you pay low fees. For a lot of folks, I won't go into 401ks here because you guys are entrepreneurs, you're going to be small business owners, or you already are. And whether or not you'll have a 401k will be up to you, perhaps, as you build out your business. If you work for a salaried job, or work for an employer, work for the government, work for a school district, work for a hospital, you may very well have a 401k. That's a workplace retirement plan. Take advantage of that. You get a match potentially from your employer, free money, and you get a tax break. I want to go straight to the individual retirement accounts because that may be more apropos for self-employed folks. IRAs are, as the name implies, something you yourself create and do. You go to a bank, to a credit union, to an investment company, to an app like Betterment or Acorns. You go to the tab that says open an IRA, you choose an investment strategy, you put this together yourself and decide how much you're going to contribute and how often to an individual retirement account. The advantage of these over random investments like using your Robinhood app to buy a few stocks or buying cryptocurrency is that when you make a contribution to an IRA, you reduce the taxes that you pay. That's why I mention it here. The way you reduce your taxes depends a little bit on whether you choose to contribute in a traditional fashion. That means you're seeking the tax break this year. That money can then grow, and when you retire, you'll pay taxes then, later in life. Tax break now, pay taxes later. Or whether you contribute by Roth. With Roth, people are making a strategic decision to actually pay the taxes now for any number of reasons. Maybe they think their earnings are lower now, such that their tax bracket would be lower. They're going to go ahead and pay the taxes now, let that money grow, and then give themselves the benefit of a tax-free withdrawal in retirement. Two very important ways to invest. Some of you may want to invest for your children, whether that's for future education. There are something called 529 accounts that are offered by most states and the District of Columbia. You also get tax advantages here. These typically come in two different ways. The education savings plan is where you're putting money away that will later be used for qualified educational expenses, or prepaid tuition plans. Oftentimes when you do that, you have to be a resident of the system that's offering the prepaid tuition, whether that's in the district or other states. I think the district allows these to be used, perhaps. I don't want to say that because I'm actually not an expert on prepaid tuition plans, but that's where you're paying the tuition now that will cover future tuition. Doesn't cover room and board and other expenses. When you open in a 529, you usually will have an option, a menu of potential investments. These are usually mutual funds or exchange traded funds, and they're set up like those target date funds that I mentioned to you earlier. Usually when say your child is 1 year old and you start making these investments, they'll be in a more stock focused, aggressive mix of investments then than they will be as that child approaches 18 years old and is getting close to the time they'll need to use them. New innovation on 529s, if you have funds that are not used, the Secure Act will allow folks to put unused funds up to a maximum of $35,000 into the beneficiary's Roth individual retirement account. So we don't just lose this stuff if, hey, your kid got a scholarship, or hey, your kid didn't go to college, or whatever might happen, and you have funds in there. Thank you, Jen. We have a lot of great information on 529s and everything else I'm talking about here on investor.gov. And I see we're getting pressed for time, so I'm going to skip diversification. We've covered about that. Active trading, you might think you profit more the more you trade. You know, those day traders must be doing great. In fact, studies have shown folks who trade a lot tend to underperform the market. And those very few who do profit from their trades, those frequent trades, typically are going to pay higher taxes on the profits. Why? Because they're making short-term trades. And that's going to be treated at your ordinary income tax rate, which is higher than that sort of incentivized rate that we pay on those long-term investments like your IRA. Fees are important. I'm going to skip them in the interest of time. Be careful with crypto assets. A lot of folks think this is a hip new way to make a lot of money quickly. They have FOMO, the fear of missing out. But remember, with crypto assets, they have not been around that long. Even the grandfather of crypto, which is Bitcoin, has only been around about 15 years. And these are highly speculative. folks who are buying crypto typically are assuming that someone will pay them more than they paid. They are speculating that that asset will increase in value, and it won't necessarily. You don't know. There are no equivalent investor protections with crypto assets as we see, for example, in money you put in the bank. Your money in the bank is protected by FDIC insurance. Even if the bank becomes insolvent, your funds are safe. If you have a traditional brokerage account, your money is protected by what is called SIPC insurance. If the brokerage goes under, your money is safe. There are no equivalent protections in the crypto space. We've seen scams everywhere in this space. We've even seen middlemen or exchanges where you park crypto assets go under, become insolvent. People have lost money not because the underlying asset became valueless, but because the middle person that held the assets disappeared with the money. And so my takeaway advice on crypto and other risky alternative investments is only invest an amount of money that you could afford to lose, because you very well may lose it. If you're using investing apps, they can incentivize you to contribute to a 401k, to an individual retirement account, to a savings account. There are a lot of positive things there, but some of them may give you access to complex or high risk products or strategies like options trading or margin accounts where you're literally borrowing money to make trades. Be very careful if you're getting into that type of trading strategy that's risky. And some of the apps, just like every other app you use, whether it's a gambling app or a video game app, they're going to try to keep your eyeballs on the app. If you don't trade with an investing app, very frequently you'll get an email saying, investors are making big bucks on these 10 hot stocks. And it will nudge you to trade more. And I just refer you back to that other slide that said, the more you trade, the more you do not profit. So be very careful there. And let me just do 1 minute on fraud, because I don't want any of you to lose any of the money that you invest to a scam artist. If something sounds too good to be true on a Reddit chat room, on a YouTube video, on a social media app, a friend who's pushing something, trust your gut instinct. It probably is. I've never met anybody who's made a lot of money quickly in investing. This is a slow game. Proceed in a disciplined fashion, and you can really put that formula to work for you. Be extra careful if someone asks you to pay for an investment with Target gift cards, with cryptocurrency, with a wire through Western Union to the Cayman Islands. These are ways scammers like, because they're very difficult to trace or to pull back the money. Don't be pressured to buy quickly. No legitimate investment will ever require you to make a rash decision. And do your research. Take the time to research your investments. Take the time to research any investment professional. Go to unbiased sources. Investor.gov is certainly one, but there are others. Morningstar, if you have a public library membership, Value Line, Yahoo Finance, Google Finance, Wall Street Journal, any number of sources you can go to do research. And let me stop there, Dolly. I don't want to go further given our time restraints today, right?
Yeah, I think that's a good idea. I think it might be good if we just see if there's any final questions that the audience may want to ask Stacy or Tom. Any final burning questions? No? We'll be sure to take an opportunity to download all of this amazing information in the chat. I think with that, for anybody who wasn't here before, I'm Dolly Turner from the Department of Insurance, Securities, and Banking. We'd love to thank Kate and Camille and the members of the Aspire and Dream cohorts for joining today. It was great to meet you, and we're here to support you. Also want to thank Stacy and Tom for an amazing, super informative presentation. I definitely learned something myself. We look forward to working with you all again, and we plan to continue to collaborate with DSLBD and look forward to seeing you at the next workshop. Stacy and Tom, would you like to say anything in closing, or Kate?
Thanks. So I just want to say thanks for having us. And I hope you walk away with some good information. And thanks to Jen for dropping all the information into the chat.
And I'll go ahead and, oh, go ahead, Todd. Please go ahead.
No, I want to thank you all very much for the invitation today. Somebody just asked, is there anything for someone who's new to investing on investor.gov? Yeah, there's actually a tab on the landing page, which is Introduction to Investing. A lot of good resources in there. Browse through investor.gov. I hope you'll find it intuitive. And there are any number of ways, if you have a question about your own investments or a question about your investment professional, to reach out to the SEC through investor.gov. You'll see them on there under the Get Help title.
One last thing I just want to say, and this was one of the reasons why it was really important for us to provide this. And, I want to thank DSLBD. When you work for large companies, corporations, organizations, you have access to tremendous amounts of information. If you're an entrepreneur, you work for a small company, a small nonprofit, this type of information is not available every day. And the information shared today could have a significant impact on your life. So, if there's only 3 things that you do, 3 pieces of advice, 3 steps you can take, they shared lots of different options. Please do at least 1, 2, or 3, and you'll really be surprised at, how it might transform your life.
Great point.
I was going to say a huge thank you, both to our colleagues in the federal government, our colleagues here in local government. And the last piece that I'll just mention is there are a lot of free resources for entrepreneurs, a lot of free information. And so we appreciate our government partners, and we'll continue to bring a few more sessions. We have a few more sessions with the Department of Insurance, Securities and Banking actually coming up in the series, including tomorrow. So we hope that you make it back. And if you are watching this on a recording, we hope you check out some of those. Thanks, everybody.
Thank you all. Bye-bye.